How the heck are you, Gain? I'm Roger Herring, the CEO and founder of Investors Accounting LLC, and welcome to this week's edition of Ask Roger. You get to ask me a real estate related question, and hey, if you'd like to get in on this, you can drop us a message at info@investorsaccounting.com. You can put a comment right here on the video. You can shoot us a message on Facebook or over at Instagram. Alright, today's question comes from Robert in Gainesville. And he says, is it better to have a paid off property or to carry a loan? Well, here's my first question. There's a lot to be said about a paid off rental because it's going to cash flow. But what are you trying to accomplish? Do you just want one or two rentals that you want to cash flow and you don't want to have to worry about a note? Or are you looking to build a portfolio of rental properties? You know, I can show you a couple of examples, so let's go to the board. Alright guys, I've put together an example based on a real property owned by a real client. The only thing that I have done is for the debt service, I have gone out and looked at the actual rates and actual payment amounts. So, let's assume that you have $100,000 that you can invest. And let's just assume you buy one rental property, and each year that rental property is going to cash. You're going to be able to rent it for $10,000. That's your rent. Now, you got some holding costs, and let's just assume that they are about $2,000. That means that you have a positive cash flow of $8,000 a year. Well, that's a heck of a lot more than you're going to make in the bank on that $100,000. But what if you did something different? What if instead of buying for $100,000, you went out and you put $20,000 down and you financed $80,000? Okay? Now, you've still got the same $10,000 in rent, the same $2,000 in holding costs for an $8,000 flow, but now you've got $5,000 of debt service. That leaves you with $3,000 positive cash flow at the end. But wait, you only put up $20,000 of your own money. You've still got $80,000 left. You can do this 4 more times, so you have a total of 5 properties. So we put a factor of 5 on that $3,000. Now all of a sudden, my cash flow is $15,000. So I've got my same $100,000 in play. I've made 15% on my money for the year. That's not a bad deal. So, do I want to leverage or do I want to pay cash? I want to use leverage, guys. Because guess what? This rent is going to go up. If I've got a fixed rate mortgage, that mortgage rate, that debt service isn't going to change. So over time, I'm hedging against inflation. As my rents go up, my mortgage service stays the same. At the end of the day, I prefer leverage. So at the end of the day, guys, I prefer to leverage my properties because I can control property with a little bit of my money and some leverage. I can control a lot of property with a little bit of money and some leverage. Until the next time, Roger out.